right, welcome back, everybody. I'm John Caruso, Senior Market Strategist at RJO Futures, and this is another edition of Rolling Trades. Of course, today's September 24th. Last time I was in here, we were discussing the Fed. It was pre the September 17th Fed meeting. We were going through some projections and what the market expectations were, and of course, they did come through. They did cut interest rates by 25 basis points as to what Powell described as a risk management cut. He certainly expressed concerns over the labor market. I did go through several slides showing some slowdown or some slowing activity in the labor market. And he also did acknowledge that inflation remained sticky. So weighing the balance of risk, Powell and company decided that it was best to cut interest rates 25 basis points. We are still forecasting another 25 in October and again another 25 in December. And as we mentioned last week, when it comes down to it, the Fed will acquiesce to inflation when it comes down to saving the labor market and saving the consumer, as well as saving GDP. In the meantime, remember, we've got 37 trillion reasons why you've got to keep the economy together, the labor market together. You need the consumer. The consumer represents 70% of the economy. So that needs to hold it together because we have our interest expense on the debt now tracking at over $1 trillion annually. So the Fed, once again, will acquiesce to higher inflation. And some of the markets moves that we're seeing here are certainly reflecting that. Fed forecast, they are forecasting 4.5% unemployment rate by the end of the year. That was unchanged. And inflation, they're looking at core PCE inflation running at 3.1% and 3% on headline. But eventually, get this, eventually moving towards 2%, the Fed's target, by 2028. So 2028, that will mean that going back to 2022 when the inflation, or 2021 when the inflation started to build and then peaked in 2022, that will mean that the Fed missed their 2% inflation target for 6 years. 6 years they've been talking about 2% inflation, and they're suggesting we're going to see it in 2028. Moving on, we did hear from Powell yesterday. He did deliver a speech following up last week's FOMC. He did mention that there is no risk-free path for the current stance on monetary policy, and I completely agree with that. When it comes down to it, they have a dual mandate, but they only have one tool that they could use, and that's moving interest rates up and down. And currently, we are seeing some diverging. We are seeing labor and inflation on a diverging path. Of course, low unemployment is full unemployment is one of their mandates, and stable prices, inflation, is the second part of the mandate. And when you see those two components begin to diverge, and the Fed only has one tool to raise or lower interest rates, you can see how that is going to be posing a problem here down the road, and what we believe will translate to higher inflation to come. The other thing I will mention, Powell did mention the elevated levels of equity valuations, which was interesting to see. We did see the stock market start to pare back some of its gains that we have packed on here yesterday. So we saw a little wiggle to the downside. I do still fully believe that dips are going to present buying opportunities for investors, but we're going to run through that a little bit later in this segment here. So once again, we're going to start where I always like to start. We're going to jump right into the macro. I got a few slides here prepared. Here we go. Okay, growth versus inflation dynamics. You can see that year-over-year GDP has steadily been slowing over the last 12 to 13 months. And we are kind of settling in this low 2% range as we move through Q3 and into Q4. However, the quarter over quarter real GDP, seasonally annually adjusted, is set to reaccelerate right now. We do have the most recent Atlanta Fed GDP Now forecast coming in at 3.3%. Our forecast right now is a little bit inside of that. It's at 2.9%, but we did see that hot retail sales number that came out about a week and a half ago, and the control group accelerated 0.7%, which still signals strong consumption in core goods. So it does appear as if the economy is reheating as we move into Q4. I'm going to repeat that. We are reheating as we move into Q4, and the Fed is about to embark on a rate cut cycle. So keep that in mind going forward. Taking a look at CPI, we've got year over CPI up there. Inflation, we do believe everything that's happening right now from a monetary and fiscal standpoint is a reflationary policy. We're seeing that not only here in the United States, but we're seeing that in some other major areas of the world, China being one of them. Now, of course, looking ahead on Friday, we do have the PCE index coming out. That, of course, is the Fed's favorite inflation gauge metrics. So we're going to be glued to the screens on that one. I could see a dynamic where the PCE number comes in slightly hotter than expectations, but then we follow it up with the labor report the following Friday, and we could still see some more signs of slowing in labor. So you see how that dynamic comes back into play here. And if that were to be the case, you are going to see all systems go for another 25 basis points cut at the October meeting. Inflation, when we take a step back and look at what's going on, debt and deficit spending, right now the United States is running a deficit of 6% of GDP. Last year, we were in a similar situation. We're seeing debt and deficit spending in China as well. So all of this is very dollar devaluation, this policy, which, of course, all of these commodities that we trade here on the American exchanges are priced in U.S. dollars. So when the dollar devalues, the price of goods and commodity prices tend to reaccelerate. So we are looking for a little bit of a broadening out of this commodity reacceleration that we're seeing. Largely, it's been concentrated in the precious metals space as of late. But I think as we move into Q4, you're going to start to see that commodity trade begin to broaden out. Let's jump into some of the charts right now. There's the U.S. dollar on the brink, down 11% year to date. As I just aforementioned, debt and deficit spending, dollar devaluation. Now the Fed is cutting interest rates to boot. That is all very bearish for the U.S. dollar. Now, when I look at this on the chart here, we could potentially see a near-term bounce in the dollar that could potentially take us back towards that 99 level. But certainly a lot of bearish forces exist on that chart. That is a weekly chart, by the way. And I do believe that we are encountering a structural bear market in the U.S. dollar. So any bounce that we get here over the near term, I think is likely going to be short-lived. I think the U.S. dollar is going to follow the path of the short end of the curve, and we believe the path of least resistance for short-term interest rates is still lower, and the Fed, of course, is embarking on an interest rate cut cycle. So that's a look at the U.S. dollar. Taking a look at gold, up 42% on the year. Gold is having its best year since 1979. Central bank demand has just been absolutely insatiable. Central banks are buyers. They're largely price insensitive when it comes to buying gold. The chart that I have up there, I show I've got two paths potentially painted, but all roads typically lead to one place, and that's higher gold prices to come. We did see a recent breakout on that chart of 37.44. We did see a little wiggle lower after the Fed meeting on Wednesday. There were some economists that were describing it as a little bit of a hawkish cut, and I think that's why the price of gold had that little wiggle lower. But then the breakout back above the high, 37.44, and I think that increases the probability that gold is going to go grab that next important level above, and that is 4,000 an ounce for the price of gold. Now, in the event we do see a correction in gold, I do think corrections are going to be limited to approximately about 35.50. That was a major breakout level for gold going back to August. So 35.50 should contain any downside moves in gold. But right now, as you take a look at that chart, when a market breaks out like gold, it offers very little opportunities to get involved. So it's kind of the old saying, when's the best time to plant a tree? It was 10 years ago. When's the next best time to plant a tree? It might be today. So keep that in mind in the gold market. So gold, we still think has plenty of runway down the road here. So flipping over, we're going to take a look at silver. Silver, the poor man's gold, up 48% year to date. Obviously, silver is a major component in the solar industry with solar paneling. We are seeing Saudi Arabia ramping up their solar projects. Silver has also been in a supply side deficit for the past 5 years, not to mention the gold to silver ratio being so lopsided, or silver to gold ratio, I should say, at 86 to 1. I do believe the historic average for that gold to silver ratio is typically in the 40s. So silver could be the catch-up trade going forward. Silver's moving up, obviously, in much of the same reasons the gold market's moving. Dollar devaluation policy, that remains a tailwind for the price of silver. We are starting to see real industrial demand for silver. So if you recall back in 1980 when the Hunt brothers took delivery of silver and were cornering the market, we're not dealing with two brothers in trying to corner a market. We're dealing with industrialized nations, real industrial demand for silver. And I still think there's plenty of runway here. Silver did clear a very important level recently. It was a high made in August of 2011. That price was 44.27.5. We have since cleared that. And to be honest with you, there really isn't much in the way of resistance until we get back to the all-time high at 49.80. So silver still could have some runway. We're going to keep an eye on the PCE number on Friday. So if that does come in hot, you might see a little bit of a wiggle down in silver, but I think that's only going to present your next best buying opportunity for silver. Switching over, we're going to take a look at the S&P 500 real quick. Up 40% since those April Liberation Day lows that we saw, down at 48.32. Currently trading 67.56. We did see that modest wiggle down on Powell yesterday. But that market, clearly bullish trend, up 40% since the April lows. And the next logical upside targets are up around 7,000. Now, are we overbought? Are we richly valued? Sure, we are. I'm sure that we are. But the next chart I want to show you is that market positioning matters. And the next slide that I have here, market positioning remains bearish right now. These are two charts that I look at. The one on the bottom, the top chart right there is implied volatility versus 30-day realized volatility. What that shows you is expected future volatility. That means the market is buying a lot of puts. And a lot of that is largely probably protecting existing long side positions, but they are betting that we are going to see volatility creep up into the market here. And so far, we've seen the implied volatilities be in a premium for the last 2.5 months. And 120% on the S&P 500. I've been following IVOL for the last 15 years. And that is a very elevated position in implied volatility. And it's a pretty strong contraindicator that this market could continue to squeeze higher. The chart I have on the bottom there, that's CFTC non-commercial positioning of the market. You can see the massive short position in the S&P 500. That actually went up 48,000 contracts week over week. Now, this report comes out every Friday, so we're going to get another peek of that this Friday. But that short position grew another 48,000 positions week over week to minus 200, to a net short position of 218,000. So if I know anything about markets, trading these markets for the last 20 years, the market tends to please the least amount of investors. And right now, you've got a good old-fashioned market squeeze happening. As far as monetary and fiscal policy, we've run through the gamut. Monetary policy, fiscal policy, all very reflationary. Then we see the retail sales numbers that come out. We're forced to upgrade our GDP forecast. The Atlanta Fed has to upgrade their GDP forecast. So the Fed is cutting interest rates. We're running 6% budget deficits into a potentially reaccelerated economy into Q4. That's a very bullish situation for the stock market. Now, how much we've pulled forward remains to be seen. And we do believe that corporate earnings and profits are largely going to hang in there through year end. This paints a very bullish picture for the markets going forward. So there will be some corrections along the way, but I do believe they are largely going to be contained, and they're going to be viewed by the market as buying opportunities. That's the information that we have available to us today regarding the stock market. Lastly here, I want to hit on the Market Pulse. I write the Market Pulse every single morning. If you're interested in receiving some of these insights on a daily basis, I do push that out to clients every single morning. That's usually in your inbox by 7:30. We hit on a lot of these macro topics. We update our models. We also do have we do kind of marry the macro, the growth in inflation and Fed policy dynamics. We marry that with a technical process that we go through in terms of analyzing charts in our entry and exit points for clients. If you do want to receive that and jump on that list, we just simply ping me at jcaruso@rjofutures.com. It's completely free. I don't know why you wouldn't jump on the list. Just reach out to me, and we can certainly get that out to you. So that is going to conclude today's episode. I hope to see everybody back here next time. Once again, I'm John Caruso, Senior Market Strategist, and that is Rolling Trades with RJO Futures. Have a great day.
The risk of loss in trading futures and/or options is substantial, and each investor and/or trader must consider whether this is a suitable investment. Past performance, whether actual or indicated by simulated historical tests of strategies, is not indicative of future results.